Market watch is here. The market is getting a little nasty. We are just talking about how the VIX is seeing a little love, which means people may be betting on the downside. We're going to break that down. We're going to talk about the Tesla shareholder vote. We're going to talk about NVIDIA. We're going to talk about some of the main data tech growth names that we've been talking about. Then we are going to get into a passive options trade, get you guys some free passive income. And pretty much everything else is just going to make you money. How you living, baby?
Doing well. I mean, today, software is doing well today. Finally, it's bucking the trend.
You're
You see
getting
Snowflake
your
up
day.
2%, MongoDB up 3, Atlassian up 3. So I won't jinx it. We have 30 minutes left, but Adobe's earnings yesterday could put a near-term bottom in software. We'll see.
Ridiculous. Still, do something with the cash. Like make something happen. You got all that money. What are you guys doing? Whatever. We've talked about Adobe, guys. It's they're just not going the places they need to with the name recognition they have, and that's the disappointing factor. So let's get this chart up here. Let's talk what's going on here. I mean, shareholder vote looks like it's a resounding yes.
So first off, like again, I love to see it. All the admin FUD is over with. We can actually talk about the business org. We can talk about Optimus, FSD. We can talk about actual tailwinds for the company and not if like Elon's going to be our CEO anymore. So clearly today I've been getting a lot of questions today, like why the pullback? Like everything went according perfect. And also Elon just casually threw out that he thinks that Tesla could be a $30 trillion company. Why the dip? It's because usually these kind of events, like you saw, Tesla had that move. Always when there's a major catalyst event, look to the left. If it's ran up according to a major catalyst event, most likely it's gonna have some profit taking afterwards. You saw it with Apple in the WWDC. You saw it. You see the earnings, like a lot of the names who ran a ton before earnings, like the Dells, for example. That comes to mind. Like they sell off because the move has already been made. For Tesla right now, that's fine. A lot of the move you see today is based on a lot of the interest rate sensitive companies, especially in small cap. You're seeing they're all really red today. And although Tesla has this vision of Optimus, FSD, like AI software, that's not the reality today. Reality today is they're at the realms, like they need EV, like the rates go lower and they need more cars to be on the road and need like the deliverables for the cars to be produced. It's like they're very sensitive to the rates and they kind of get participate in the trade of like if everything that's rate sensitive is selling off, like Tesla will participate as well. And you saw like with the massive they had 2 days ago or even 3 days ago, like they went up a lot. It's because a lot of the rate sensitive names pick back up, but we're holding a very key level. Like again, like I think we might be basing now. Fine. I still think we're going to hit 220 real quick on Tesla's chart. If not, buy again close to that 145, 150 range. You saw that trend that Austin and I put together for you. Like it's trending up. It's probably going to hit it again if we get some kind of macro-driven pullback in the market. And I think it's going to shoot up. But either way, I added 25% in my position today. I de-risked it a bit before the shareholder meeting just because I need some capital to add to Snowflake and MongoDB. And now that this de-risking event's over with, I added back in and all business is good. Now we can think about 8 events in 2 months.
I think that level that we identified is like it's so critical it's not even funny. Like because if you look at this chart, zoom out a little bit to go to the daily here. We did gap up, right? 190, boom, exploded. Mm-hmm. Now we're closing that gap. Not the worst thing as long as we can recover 182. If we recover 182, I think we're good. And again, we've always talked about that golden breakout. Like we want to see north of 203. I think we're going to 268 again. Like that's cake. That's happening. We talked about the buy opportunity here and the volume that we saw into the break up to like I think we went to like $200. So again, we bought this 140. We were sitting here with you guys live talking about this. It explodes in like 5 days. You basically hit a 20% lick on a large cap company, which is crazy. In just a few days, Tesla does do that at times. And we almost closed this gap to 208. I think that's really like what we need to see is like we need to see this up at 208 plus before like I think at least anyone that's looking at a technical trend as a reason to buy or sell, they're going to be looking at that as a very bullishly optimistic sign when we do see north of $200. Also, psychologically, I feel like it just makes a difference. Seeing that one is not fun. You know what I mean?
Yeah.
It's just not. And so I think that most of the people look at NVIDIA. I mean, how many people were like, I don't know. We were talking about this over a year ago, buying it pre-split 160, pre-split, which means for perspective, it ran over 1,000, split 10 to 1. It's 1,000% return. Okay. So 1,000% ago, we're talking about this is a great idea. And now everyone's buying it after it's run 1,000% from when we were like, hey, this is a great buy. Runs 1,000%. Now look at the liquidity in the market. I mean, it's dwindling today, but like I'll pull it up. It's just been madness. And then even so, when this split and we were trading right around $100, we told you, hey, this was our target. This is already on my chart. You can see this right here, 140. That's what we were targeting. And it looks like we're approaching it with velocity here. Today, getting that higher low, I think, was pretty significant in terms of confirmation the move's coming. Volume has been dwindling. We want to see that volume. I want to see like 400 million a day, realistically, to be confident that these moves are going to stick. Right now, like yesterday, we're at about half that. So again, we're holding trend dating back to May. Where it's going to go from here. But the point is, like, how many of you had zero consideration to buy this before it ran 1,000%? Feel free to raise your hand. Versus how many have bought this after it's run 1,000%? It's difficult, man. It's just difficult. It's a difficult thing. And I know people struggle with it. And we're just here to try and make that burden a little lighter so that you could be the one sitting there laughing all the way to the bank when you're up 1,000% and all of a sudden it's all over social media. Plain and simple. But I don't know.
Yeah. You're also right. Nobody back. First off, I made this comment, I made this post earlier. Like NVIDIA 5 years ago, nobody thought they would be a mega cap. They truly thought they're going to be a gaming chip company. Now look at them. They're the center and the king of the new digital economy. That's the type of potential that I'm not going to say Tesla's going to have 1,000% move. But if there's any kind of truth of what Elon said yesterday about Optimus, they have that like potential, that insane move upwards. If Optimus is correct, what Elon's saying, they already have the EV market share.
Wait, recap that. Recap the Optimus thing. Just quick little.
Let's see. Let me pull it up.
What does that mean?
So Optimus is those robots. If you guys know, let me pull it up right here before I speak on it. Okay, so where is it? I gotta do better with my notes. All right, so Elon said it is conceivable that Tesla achieves a 30 trillion market cap just based on Optimus and autonomy, FSD, alone. Optimus will probably be 25 trillion. FSD will probably be 5 trillion. And he agrees with Kathy Wood's $8 trillion prediction of market cap in 5 years. So right now it's a $500 billion company. Essentially, it's roughly a 20xer that Kathy Woods is saying next 4 years. Elon just backed it up. I know it's like, oh God, like what the hell? Like that's just throwing numbers out there, but it's not inconceivable. Like it really isn't. And the reason I say that is because Elon, like if they have, he says there's gonna be 1,000 of these robots next year in their factories. If that becomes like a normalized thing, do you not think the whole industry is going to start using these robots to automate their warehouses? They're absolutely going to. Like it's an unfortunate trend that we're seeing in society, and it's going to probably continue with AI and Optimus type of technology, where like people will be losing their jobs. Like the way that companies will be more efficient and optimize their bottom line will be headcount reductions. And there's very few names, if any, on the humanoid robotics side of it, other than Tesla. So if that actually becomes like a normalized thing and it gains momentum next year, and all these OEMs essentially like the Fords, GMs, like the way they produce their cars, if they all have to use these robots as well, like every industry that requires a warehouse, which is so much, it's the commerce, the retail, cars, like it's endless. If they all use the Optimus as like the basis of like, all right, we're gonna use this until we create our own, or similar fashion, like Nvidia right now. There's gonna be a ton of competitors in the next couple of years, but Nvidia has that first mover advantage, and you're seeing that pricing power in Nvidia right now, and it's gonna be lasting for years. Tesla might have that in the humanoid robotics space for quite some time. So like that's why I'm like, oh, that's like a ballsy prediction. But even if there's a 5% chance that's a reality, you cannot afford not to participate in that 100-bagger potential in the next 5 years. And Tesla has a high floor because they already conquered the EV space, supercharging space. FSD technology is literally at the red zone. It's around the corner of being at scale finally. Like there is a high floor in the stock and even a higher ceiling due to the Optimus component of it. So like that's why every single 2 weeks I'm adding 5 shares into my Tesla position. I don't care what the price is. That's just my DCA plan. Probably reevaluate in a year or 2 years to see how close they are to like what their predictions are. But again, like it's irresponsible not to even have a couple chips on the table for Tesla with that insane potential that these visionaries, Elon and Kathy Woods, are both predicting. Okay, well, they must know. They play chess. I play checkers. All the retail plays checkers. So clearly they have some information or some knowledge that makes them believe this and put their neck out there for that. So I'm like, all right, I'm going to respect it. I'm going to continue my DCA plan and participate.
Yeah. And I mean, there's nothing more you can do than just follow what you're given in the market. And again, to flip back to that Tesla chart, let's talk a little pricey price. This thing routinely has had explosive moves in the past. And I think that's important to identify because, again, we talked about that 204 level, right? So if we go back to, what is this, June of 23, this stock moved 47% in 48 days, 1% a day, effectively, right? If you average that out. Then if we look at the next time that we saw explosive upside, we were coming from a low of 213. We moved 30% in 29 days. Again, almost 1% a day. Again, this is all about the law of averages, my friends. If we look at this critical area we've outlined, see these lines are a little bit thicker. That means that this is my key range, right? 204 to 266, give or take. We have moved 44% in 35 days from this same level. We moved 30% in 119 days. Took a bit longer. Nevertheless, still saw the move. Point being, stocks are reactive as much as what Shai's talking about. You know, there are people playing chess here. There are people dealing with significant investments of hundreds of millions of dollars. It's also important to know. But there's also the market mechanics that are just always as straightforward, I think, as it can be, in that when you identify a range at which the stock moves and you can extrapolate that out to prove that model, like, look, did it 3-4 times, we can go back and look and say, hey, every time out of the last 5 opportunities, this has gone from 204 to 266 on a positive sentiment in the market. Why would we think anything other than that would happen? Mm-hmm. The past is the future with the lights on, right? In most cases. So we look at this, and that should tell us, okay, this is our bottom, at least as far as a trade goes, right? So let's talk trade. The trade here is simple. I mean, we've been adding long-term support. Look at this. I drew this all the way back to a functional pivot point from May of 2019. So if we have price data from 5 years ago telling us this is a very important long-term trend, and we are abiding by that long-term trend, we would be stupid not to take advantage, right? So again, we were buying it. I got to give Mr. Stocklet Profits in the Discord credit. He was the one buying this at 110. It ran to $300. So nearly 200% return, right? Now we're talking about the adds to the position here at 140. So Shai and I were talking about instantly pumps 20%. More importantly, we have a huge cushion on the long-term position now. So for anybody that's looking to have an investment in this company, again, it's not advice, but here's what I'm doing. I'm buying this long-term trend line. If we get another opportunity, God help us, I would love it, to buy off this long-term support. I'm taking it because it creates a very simple trade wherein if we break this support, trade's done. It's just over. Get out. Simple as that. Do I think that's going to happen? Very unlikely. So all that means is we're getting more time and more opportunity to DCA in, build a significant position, so that guess what? When we finally do break above 203, 204, we go to Boomtown and we were buying at 150, 160, and now we're trading at 260, $100 a share. Pretty significant uptick. And again, I also don't want to sniff at the fact that when we break above 260, 400 is on the horizon. So to put that in perspective, what we're saying is this: we're buying at 140 a share. Our upside that we know of, given the market we've had, is 400 a share. Almost 300% profit. In the last time it did this move, it took...
It's 3 years, 2018 and 2021. So like that move right there was, people didn't believe that they can make a profitable company with EVs. They doubted it. Once that quarter happened, like, oh shit, free cash flow positive while growing top line 30+%. What he was saying is true, and they have a first mover advantage. They're going to capture most of the market share. You saw that 1,000+ move right there. That's what I'm talking about. That the next leg is going to be those doubters are going to be turned into, wow, we're going to see those software margins from FSD come to play in their fundamentals. And we're going to see the optimist component of like down the line tailwind combined with their already EV floor that they have in their business. Like, what the? This is going to be a trillion, multi-trillion-dollar company, and people are going to have FOMO. It's going to gamma squeeze real hard. And the fundamentals will back it up, because right now it's a 30-something% free cash flow, 30% gross margin business. With that FSD component, it's going to be 60-70% gross margins. If that becomes more and more of a way of the revenue, that 30% total company gross margin will turn to 50% real quick. And that's a different story on how to value a company. Now it's, oh, you could value this as a software company, that recurring revenue component in FSD. The Optimus is going to have good gross margins as well. Like, this isn't just an OEM EV company. And now everyone's going to have to re-rate their models for the next 5 years. And it's going to be an earnings and expansion story with top line growth combined. Holy moly. I don't know when that's going to happen. I'm underwriting sometime next year or two. I think that's when the moment's going to be for that FSD revenue coming in, and also some Optimus potential tailwind news. But it's going to be crazy. And people miss out on NVIDIA. I missed out on the big move in NVIDIA, but I still captured the 4Xer. I sold it in 400 too early, but like, I still had FOMO of like, damn, like this was an $80 billion, $150 billion company at the time when I looked into it. I was like, oh, this makes sense. It's going to be like a mega cap. So I bought in. But if I held, that's an 10Xer so fast. And it's probably, NVIDIA's going to be at the king of the digital economy for quite some time. Like, right, I wouldn't be surprised if they're going to be a $4 to $5 trillion company in a couple of years. That's a crazy thing to say, but like, it's we're seeing it right now. Like, it's not the wildest thing in the world that it's going to be massive mover and king for quite some time.
No, we're in an irrational market. We're not an irrational market. This is an irrational market. And the good ones, I think okay, this is important. Everything exists within this ecosystem, right? Like, we're just people, but the macros in life, it's all the same thing, right? The Fibonacci sequence is a great understanding of the transition from like nature and math to real world application, right? For those of you that know, and not to get into sacred geometry and all that, but like, if you've noticed, if you go into like the pure foundation of who we are, what we are, it is a very beautiful geometric pattern, right? And ironically, those same patterns follow us into finance, into the stock market, and everywhere else that we exist. Mm-hmm. So to think that things are disconnected would be an irresponsible outlook that I don't have and won't have. The disparity in wealth since COVID is only basically increased in size. Those that struggled before financially struggle even harder now. Mm-hmm. Cost of goods has risen. Estimates 40%. Fuck you. Just consumer household goods, 150% minimum. Realistically, if you go 2019 to now, it's over 150%. I don't know where they're setting their baseline anchor, but it's bullshit. It's 150%. It costs you double to go get groceries what it did before, right? But your paycheck hasn't doubled. Mine hasn't doubled, right? However, corporate profits have effectively doubled. Payouts have effectively doubled. And ironically, you look at what the market is doing in reaction to this, the same thing. It's functioning in the same capacity. The winners get 10 times the play they would have before. The losers get beat down 10 times worse than they would have before. So again, to speak to an irrational market, for us to not bet heavily on the winners, I talked about, this is not about the stream, but like I talked about early this year, basically Shy made an announcement in Discord. Look, I'm changing my entire strategy. This year's a different year. This is a different deal. I am taking a more concentrated approach to my positions I'm just basically going fewer names, higher conviction. So more money per play. Dude, best year I've ever had. Hands down. Got to give NVIDIA a lot of credit. It's carried the water for a lot of it, but so is Robinhood. So is Palantir. So is some of these other names that were just like a stupid, easy growth story to look at. And it's made this year the least stressful, most profitable year I've ever had.
That's amazing. That's all you can
Already
ask for.
100% year to date, and we're only halfway through the year. So for perspective, you guys, those trends, to see those trends is a gift, and we have to really focus and be present to see them. To try and buck those trends, that would be stupid on our part. So again, that's why we've talked about even some, like, I got to give Shy credit where it's due with Jamia. No one was looking at that. Nobody. But the second you see it, you guys ever have that moment where it's like somebody says something and just clear, like, oh, holy shit, that's so simple. And you feel like an idiot. How did I not see that, right? That's what we're trying to do for you guys. Not just focus on the NVIDIAs. Like, yes, great opportunity. We gave it to you. It was already there. We're done now. Keep going. Because the opportunity from here on NVIDIA is this big. The opportunity on names like Jamia, which it's already up 100%, full disclosure, so be very careful. From his position, it's up damn near 200-something%. So just be careful. Mm-hmm. The opportunity is this. I want this. I don't want this. I don't want marginal return. I want simplicity and I want growth. And that's what kind of I think the core thesis that we've landed on is like, look, there are names that make sense to really pay attention to, and there are names that you just kind of have to ignore. I don't know how else to explain it than that. I don't know. Does that make sense, what I'm trying to say here?
Yeah, it totally does. We're not trying to hit singles like right now. Like exactly. If we want to hit singles, we invest in the Mag 7 because clearly Microsoft, Meta, Google, Amazon, they're going to be thriving in this new digital economy. But we're trying to find those multi-backers. I don't know if these $3 trillion companies will turn to $6 trillion companies in the next 5 years. Like, I doubt that. I really do. But a Snowflake, for example, is a good example of what they're worth. They're worth $38 billion. I can see them being worth a mega cap in 5 years. So like that's a 5x at least. So like that's like it's opportunity risk now. I think you really need to ask yourself, what's the opportunity risk on which names to be invested in? Because this is a once in a lifetime thematic. AI, something as revolution as AI doesn't come every like couple years. It comes once every other decade, maybe. And you can't miss out on those like massive winners in the early innings of those kind of thematics. So
yeah, I think you're right. Every 20 years, because if you look back, .com revolution, and then if you go back another 20 years into the 80s, I feel like it was also like it was a kind of the beginning of the slow moving tech revolution.
Yeah.
Basically, companies like IBM that were at that time innovating in an insane way. You know, even like my dad's company, it's like a private company, right, where he works. They integrated software in like the early 90s, and it put them in the position that they are today. Versus the competitors didn't wait until the early 2000s to integrate that same technology. And like those little small, and again, not to be crazy here about the macros, but like look at that as an example. Those small compounding returns for that private company led to significant market positioning for the remaining 20 years they had. Versus your portfolio, right? Those small compounding returns or decisions can lead to 20 years of exponential growth. Anyone who bought real estate in 2009 is anyone who bought a significant amount of real estate is probably a millionaire, or is at least extremely comfortable. My one neighbor who has like the cars he has in his garage are worth more than most of the houses on our block. Like he has one car that's worth more than most of them. I think it's like an $800,000 car, right? Like, it's crazy. And I was asking him like, hey, what do you do? It was really impressive. Wow, you know? And I think he's probably about 55, 60, so a little older, but he's like, oh yeah, we just 09, 10, we put it all on the line, real estate. And look at that. Boom. I think that I'm not knocking real estate, but we're not here to talk real estate. The opportunity there, risk to reward, is not what we're talking about here. And again, trading is the best business you could ever start for yourself because it requires little to no capital up front to begin learning.
Mhm.
And most importantly, it's something you could pick up in a year and become decent at. Now, over a couple, 4 or 5 years, I think people can become expert. And we've seen it. I've seen it with a lot of you guys that come to the stream. These companies we're talking about have the growth, but like they are your real estate. I'm sorry. We all missed the boat. All of us that are like 25, 30, we fucking missed it, man. Like we were kids then. It sucks is what it is. This is our version of that, I think. Where we can be the fucking douchebag boomers in 20 years sitting on like 10,000% capital gains, holding down the next generation that's just trying to afford rent.
No, I've absolutely nailed it though. Like those kind of life-changing moments, they're very rare. And we are in an environment where you can have those life-changing moments. And it's not just like throwing a dart and hoping something lands. Like you actually kind of have to A, follow someone who actually knows what they're talking about, B, do the work and do the research yourself to capitalize on that. Let me get into the software space, I guess, right now. Because clearly the past couple of weeks, software has been getting absolutely destroyed due to the fear of, how should I phrase this? Like, I guess due to the fear that Gen AI is going to essentially render much of what software is today nearly obsolete. And I think that's like, okay, I do believe in that because I've been very open that 75% of the software names today are probably going to be obsolete or losers of this AI theme.
Yeah,
And
.com bubble 2.0.
exactly, .com, but exactly. It's because, and also like if you're an investor, you can't rely solely on the metrics that you used to be able to before, like billings, RPO, ARR, dollar-based net retention. Like these aren't good enough anymore to justify if that software company will survive this AI theme. Like you actually need to trust a genuine expert who knows how to truly assess the value of a software company, or you need to dig into deeper and understand not just what the software does, but how it actually functions, what the code is behind it. Can this product be replicated? Because in the next like 1 or 2 years, you're going to see a lot of duplications of software products into other companies. Like I hate bashing on companies, but like a lot of the CRM companies, they're going to be duplicated. A lot of the DevOps tools, like the GitLabs, they're going to be duplicated.
White labeled, dude.
Yeah,
The CRM softwares, the customer management suite, they're just white labeled and resold with personal brand guiding the way.
Exactly. But you know what's going to survive? The data infrastructure players. Why is that?
Preach.
It's because the future of softwares are going to be built on these databases. Like in order for these leading data platforms, like the databases, like the MongoDBs, the Snowflakes, all the future AI applications will be built on top of these. So they won't be duplicated because the initial infrastructure behind all these applications, they're impossible to be duplicated because companies don't store their data on multiple different warehouses or data lakes or databases. That's inefficient.
When you're in.
Exactly. So that's your moat and you can't be duplicated. So that's exactly why I'm being very choosy on who I invest with, knowing they're going to survive and knowing that all these software companies, they're going to be fighting this battle, Hunger Games style, of eating each other alive or beating each other up, while I'm going to be the king, or Snowflake's going to be the king, these database companies, just watching everyone consolidate and knowing that all future applications will be built on top of their database. It's not going to be duplicated. So that's why right now I had 100 shares of Snowflake entering the year, second biggest position. Guess how many I have right now? 325. I've nearly tripled it in the past 1 month. That's my conviction on a name like Snowflake. I know what I'm investing in. I know their product. I know their code. Like I know they won't be duplicated. And I think this AI nonsense is so overdrawn on Snowflake. Like there's just gonna be a data warehouse company. Like that's just so delusional. And I'm happy about it. Fine, I'll add even more. But it's just like I feel like a lot of people who generally don't know the space or don't know enterprise software are just saying this FUD because Snowflake has always been this golden child in the market ever since their IPO. And now that this popular high school kid is turning slightly ugly or had some acne on his face. Now everyone's revolting against them because they had all this jealousy as soon as they went to the stock market. So like that's where you're kind of, like, it's a dumb metaphor, but kind of that's how the narrative is right now. So like I'm going to be taking advantage of this puberty moment of Snowflake that now they're transitioning from data warehouse to an AI play. Like they're transforming what enterprise AI will be in 5 to 10 years due to a lot of their announcements they made two weeks ago, the Cortex AI, what they're doing with Iceberg. And everyone's saying software is dead. Like Databricks just acquired Tabular for $2 billion just a week ago. Do you really, which is way overvalued? Like Snowflake created similar product in-house, and essentially Databricks waved their white flag on being a competitor to the Iceberg product, which I won't get into it too much. You guys will tune in like when we meet in person or like the Discord group that we have. I'll explain it there. But like essentially, Snowflake saved billions of dollars by having the luxury of leveraging the data to create these in-house products that people like Databricks or these competitors don't have that luxury. That essentially showed the moat. And right now, it is trading so freaking cheap compared to what their future value would be. And it's because the market's being very short-sighted. Snowflake's guide reflected all the AI-related investment expense, but zero revenue guidance from those investments. Okay, that's hard for me to believe. That's clearly a sandbag. And also, people are overdrawing this Databricks competition. Like, Databricks right now has a 40% higher valuation than Snowflake right now in the private markets. So everyone's saying like, oh, once Databricks goes to the market, Snowflake's gonna go down. No, Snowflake's finally gonna have a decent comp to compare it to in the market. And once they see a 40% disconnect, it's probably gonna be 60, honestly, because once stocks go IPO, they always gap up 20 to 30%. So like that's gonna show, wow, this is way undervalued, and it's gonna be a tailwind for Snowflake. And I won't get into it too much again, but Databricks had the luxury of a founder CEO who is an AI scientist. So initially from the start, they were all about AI, where Snowflake went the data route, and now they're pivoting towards AI, eating Databricks' lunch or trying to. That's why it's like the awkward period of like everyone's saying, oh, that's an AI player. Well, clearly from the get-go, day one, Databricks was always about AI. Now Snowflake is trying to transition into that as well, but they had the luxury of all this data to leverage in order to become a competitor, which I think they're going to. So I think the floor might be priced in right here. It really needs to clear 165 to buck this downward trend. I could see it hitting 110, 111 as maybe the next bottom if we do break through this 126 level that we had, which was a January 2022 bottom. But again, long-term mentality. I will be adding every single week a couple of shares. All the channel checks I've read, all the analyst notes I've read the past couple of weeks, not one, maybe a few, but mass majority of these analysts after the investor day, after the 2 weeks ago, after their presentation of their new AI products, after speaking with all the customers who use Snowflake, they all have a 220 plus price target on Snowflake. These kind of analysts, they don't put their neck out to assume there's going to be potentially 100% increase in price in next 2 years. They just don't do it. Their price targets always follow what the sentiment is in the stock, because price follows sentiment. They always do that. Like that's why you see Kramer always say the stock is amazing when it's in an uptrend. It also says, oh, I don't believe in it anymore when it's on the downtrend. That's kind of how analysts are as well. But you're seeing Snowflake's price targets from the analysts being 220, 240. It's in 120s right now. And it's just like, wow, this disconnect is like really rare, but I'm going to be pounding the table and capitalizing as much as I can, as quickly as I can, because I know this is going to be very temporary.
Yeah, I couldn't agree more. And I believe Gurpreet said DCAing into snow, currently 3.7% of the portfolio. I love that.
It's 14% for me. So I have to be a little slower in my DCA because I also want to add to MongoDB, Confluent, Atlassian. So love to see it, Gurpreet.
No, I do too. And I just actually, let me go fix this order. I had an order in. I didn't realize that we had closed for the Dizzy.
Oh, we're past one? Shoot.
Yeah. And I was trying to get that 126 fill on another 10.
Here, so while you do that, I'm going to share my other player that I've been adding, accumulating. Confluent, ticker CFLT. Let me share my screen.
Yeah, go for it. Take that.
Yeah, while you do your trade, I'll do that for sure.
I gotta get this order in.
All right. So I call. Well, actually, let's talk about ARM real quick before I get into Confluence. So we talked about NVIDIA, how they're the kings of the digital economy. ARM Holding, I've been trying to add ever since their IPO, ever since in the 60s. I was like, oh, I'm so greedy because at a time like September 2023, it got IPO. I was like, oh, I mean, I think things are good, but like it was pretty bad. You guys all remember September before October. Like October was when the rally started, but September is really ugly. So like, oh, it's a recent IPO. Usually my general rule of thumb is like I need 2 earnings reports from a recent IPO to really feel confident in investing or initiating a position. So like it's too early, but ARM is one of the best opportunities in the AI theme. It is insane what opportunity they have. And if you guys don't know about ARM Holding, essentially they provide a license, like the blueprints for all the processors in the semiconductor ecosystem, like everything they have the blueprints for the Apple iPhones, they have the blueprints for the Qualcomm's chips, like they have blueprints for the Microsoft laptops, the Apple like essentially every single new device for the next 10 years. ARM Holding, the way their business model works, they're going to get a cut of every single device in the next 10 years. Why is that? It's because they provide the blueprints for all the processors. And you're going to notice that every single new product for the next 10 years will have some kind of AI component in it. You're seeing it with the new MacBook. You're seeing it with the new Microsoft. Like you're seeing all these new products being like out there in the world is powered by ARM-based chips. You're seeing the headlines on that. And the way that ARM works is like, again, they don't own any IP. They provide the blueprints, but they have no competition. Their gross margins are 97%. So that means for every dollar that they earn, they pocket 97%. That's wild fundamentals. If there's a massive scale that's going to happen, and I think there's going to be. You're seeing it past couple of weeks with all these new products being announced. It's because they're powered by ARM-based chips, because everything needs some kind of new semiconductor chip that has some AI component or compute power that's going to make them even more fast, even more innovative, and they have to use ARM for that. So that's why I'm like, oh. And they also just they got announced they're getting into the NASDAQ. So like, I'm just like freaking A, I'm so pissed that I had that 2-quarter rule and I missed out on this massive move. So now I'm like, all right, I need this exposure in my growth portfolio, because right now, analyst estimates are like 20-something% CAGR for the next 3 or 4 years. I think that's really low. I think if I'm right on my thesis on ARM, where every single new tech product for the consumers are going to have some kind of ARM chip due to the AI component of the processors that's required for these new AI related products, like they have to use ARM. I think there's going to be a renaissance of new products for consumers, and ARM's going to get a cut of every single device that's going to be sold. I think it's like 1/100th of a cent, but like when you have so many products, like this, literally every single product that's going to be developed next 10 years, they're going to get cut of. It doesn't matter what the cut is of that $1. Like it's going to be bonkers. So I want to start my initial DCA at 113, the 21-day EMA. I like that little touch of like, all right, I'm going to do, if I want a 3% position, I'm going to do half of 1% right here. Then I'm going to do the average VWAP from the IPO price. Where's that? 98. Then I'm going to do a 200-day moving average for ARM. Around here, the $91, that's when I'm going to make this a full 3% position. So that's these exact points, 113, 98, 91. Those are the three DCA prices for ARM that I'm just going to make this a full position, because I think it's going to be ridiculous. Like the amount of money they're going to make in the next like 4 years. But that's one name. I'm going to talk about not 4 years, next decade. Confluent is the other name. So we brought this up 2 weeks. I think maybe a week ago, actually. And essentially for Confluent, like I called out, let's bring this out. If you guys don't know what Confluent is, essentially they're processing real-time data, very similar realm of business model as Datadog, Snowflake, MongoDB. So it's a consumption-based model where customers pay as they use it. So if I think data is going to explode due to AI, those are the names I'm investing in, knowing that what are companies going to have to do once they get this data explosion? They're going to have to like figure out how to read it, observe it, store it, utilize it in real time in order to dictate what behaviors the consumers are doing, or to help them decide on any kind of moves going forward as an organization. Like they're going to need it instantly, and it has to be high quality. Confluent is the streaming process component of the data ecosystem, where real-time data insight, like as it happens, you get it right away. So right now it's a very early innings of this specific niche within the data ecosystem, but Confluent management usually called out that in the future, a third of the data ecosystem will require streaming processing. So Confluent is the only player, like they're the leaders of the space. I make the argument maybe the only players. If you guys know about Kafka, which is essentially the open source product that everyone uses, that's Confluence. But Confluence building a paid version on top of that Kafka that it allows you to have all these new high quality insights in real time right away. It's like really cool features to add on to it. I won't explain it here, but essentially, if the third of the data ecosystem will be using some kind of streaming processing, Confluent will be a massive winner in this. And it's something that you can't miss out on because it's an $8 billion company. If I think data is going to explode in the next 5 years, they have an insane amount of runway, and they're just beginning. Like they're just starting. They're a very new company. But I was like, all right, well, I want to add this name. It's a little pricey in the 30s. So I would love it in the low 20s. But look at this gap down they've experienced in October. They had a really one-off wonky quarter in this earnings report. I got into it in the Discord group, so check it out. I explained it. But I was like, I think a lot of new buyers came into the stock once they saw that gap down 40% in this move. So I love to see this as an average VWAP. What are the new investors buying this stock once this gap down happened? You see how respected it got after here. People respected the dip in this VWAP. Like even over here in this bloody couple weeks we've had in software, it never broke this. It's hovering around it and it closed above. I was like, all right, I would love to add it a lot in the 23s right here because you see his massive volume shelf, but it's not going to get there. So I started a 1% position over here at this VWAP. I'll make it a full position at this volume shelf. I don't think we'll get there. But there's also another tailwind for Confluent isn't just the third of the data ecosystem is going to be streaming processing data. It's that if you believe in AGI, what Elon's saying is going to be achieved in 2 years, that is going to require real-time data, and not just real-time data, high-quality data. So you can't just use the open source Kafka. You need more than that. And if that's actually going to become a reality, you're going to need this real-time data like what Confluent offers in order for AGI to really work for a lot of these big orgs. And that's going to be a massive tailwind. So right now, there's a 25% CAGR on the top line for Confluent in the next 4 years. I really think it's going to be in the low 30s in like a year or so. And if that's the case, they have a margin expansion story happening right now where they're just hit free cash flow positive. I do think that they might get right now they're being underwritten for like high single digits free cash flow margins next 2 years. I think it's going to be in the mid-teens. If that combined with the 30% growth in top line, I think this is going to be a $50, $60 stock very quickly in the next year or so. And I just want to add this in my growth portfolio because I do think their stream processing real-time data, that's going to be a necessary component of the modern AI tech stack. And it's going to be one of those names, like I said, that will survive this because it is a data infrastructure player in a way where a lot of applications will be built on top of Kafka. So it can't be duplicated. It's one of those names I'm not scared that the product's going to go away. It's just the valuation is a bit high, and we have to see the reality of how popular stream processing data will actually become, which I think it's going to be. So we'll see, but that's a name that is on my radar. I added 2 weeks ago. I want to add a little more, but I want to see what the market holds up because it looks a little wobbly end of the week. And if we do get some kind of pullback in software again, this is the price of $22.50 that I would just like make this a 3% position in my growth portfolio. But I'll stop there because I went on a tangent a bit.
No, it's good, and the Confluent play. I also we actually charted that. I think the last time we were talking here, and like as far as bottom feeder opportunities go, I mean, just from a technical perspective, right? So like what he's saying here is like let's wait to see how the market reacts to what they're actually doing as a business What I'm talking about right here is just the opportunity as we look at the chart, forget the business, right? Huge opportunity, 25-24 critical support, great opportunity to add with a low risk threshold, because below 21 bucks, we're coming down to 15, right? So you kill it, you wait 30 days, you buy back in at 12 to 15, wherever it ends up bottoming. Best case scenario, it holds above 25.40. You get a move up to 32 at minimum. Once we break that, it's an easy move to 45. You've doubled your money with a long-term target of 63. So to me, I think that for those of you that, because I know you guys like hearing both, like, okay, this is what the business is doing. This is what the technical trade perspective looks like. Our job, I think, that as far as we discussed, is to find where those meet. Where can we find a hell of a trade opportunity that just so happens to also be a great business? To me, that's a good investment. Like, that's where you find longevity. And that's where you have your NVIDIAs, your Snowflakes, your Teslas, et cetera, right? We found the right trade opportunity on the right companies. You put it best, dude. That one time, I think about it all the time. The fundamentals tell you what to buy. Technicals tell you when to buy. That just nails it. I mean, it encapsulates the whole idea. But I love that one. To make a quick aside on ARM, I mean, I've landed on ignore all this stuff, but we like to find these points of confluence, right? And you got a big one at 205. And when I say 205, I'm also saying like that would be a late fall target should we see continuation. But the beauty is if this uptrend continues, you can see this is your top shelf right here. Let me differentiate this a little bit. Let's make this white, top shelf white, bottom shelf blue. So worst case scenario, this is your long-term trend support. So like you said, you're buying 108, 109. And to be fair, at least if you're in the Discord, we were buying this at 95 bucks. So you had your opportunity. This is your bottom shelf accumulation, right? So you want to be buying on the trend line. That's what I'm going to be doing. This is top shelf, meaning if this continues to break out here, this becomes our bottom. This becomes basically our new support. So I think that it's critical to understand that, and that where these technical indicators meet are called points of confluence, meaning all the data is leading us to the same conclusion, or at least multiple pieces of data are. So we can, I guess, put a little more weight into those speculative predictions, like this $200 price target by October. Again, pending we stay north of this top shelf support. Bottom shelf support puts us closer to 140, 150 by that time. So keep that in mind. I think that's a critical thing to kind of cover here.
One thing real quick, for Gurpreet just mentioned this for price to sales. For a business model like ARM, you can't do price to sales valuation, because why is that? They have 97% gross margins. So typically it's like, yeah, that's what I'm saying. Like, they don't own any IP. They offer blueprints to all the processors, like semiconductors, and like that's a picks and shovel play right there.
Dude, I know. Oh my God. How did I not? Jovan. Dude, I know someone from like my childhood that was recruited. He's like brilliant guy. He was brilliant. He was recruited. Like, I'm talking like a Dookie Howser kind of guy. He was recruited by them, and he was in charge of doing some of their major overseas development stuff. I got to hit him up.
Yeah, it's a UK based company for sure. So like, again, like you can't do price to sales. It doesn't make sense because they have nearly twice the gross margin anyone else does. So like, it takes essentially, if you want to, like, you can't do price to sales. The way to value ARM is, you honestly, I don't think any of the valuations make sense on the metrics, because there's no other company that has 97% gross margins. You just can't think of it that way.
I want to die. So what he was pitching to me, oh my God. Dude, I could have
when did he pitch it to you?
I don't want to talk about
it. Tell me it was like 8 years ago before they I mean, yeah, dude. A lot of people don't know this name until now, like clearly because it ran up, but I loved it at IPO. I was just like, I didn't pull the trigger, and it's one of my regrets. I want to get back in, but it is a monster company. If you actually, like, you guys don't know what to invest in semiconductors, too much competition, whatnot, ARM is the best play because it's a pure picks and shovel play of the whole ecosystem, because it gets a cut of every single one's product and processors and chips. Like, that doesn't get better than picks and shovel play than that. So, I think we'll get opportunity.
Those shares were priced at like $30.
Oh my God, you got pre-IPO pricing?
I just didn't have 250 grand cash at the time. But then
Oh
I was like,
man.
you know what? Maybe I should call some people and see if I could raise some money just to get in because I could throw in 50. Oh my God, I'm so dumb. Because it sounded like such a good idea when he's pitching. He was at my buddy's wedding. He's like pitching me on it, and I was like, dude, that sounds really smart. Like that's genius. And he was like, yeah, you know, like I've been like I'm doing it. I took the job, and like you know, he's an upper level guy. They're like, you know, I could connect you with them if you do investment. I was like, oh my God, that makes me so mad.
I will say there is a Hail Mary for us because SoftBank owns 90% of their shares of ARM Holding. So
Wow.
I do anticipate a ton. That's why it's a low float. So that's why it moves a ton because SoftBank essentially owns all of it. If SoftBank starts unloading just like a third of that, just to get to like a reasonable, I don't know, 60%, which is still a lie, that would put some pressure onto the stock price. So like that is like, oh, I'm hoping they start offloading it to like, I don't know, fund some kind of new venture like quantum computing, or maybe they want to get involved in the space economy. Who knows? But I would love that opportunity of just like them offloading it. So maybe we got a chance of some selling pressure, but it's a monster everyone should have on the radar and do some more research on if you guys don't believe me or Austin's friend.
God damn it, dude. He's such God damn it. Whatever. All right. I gotta let it go. It happens, man. It happens.
Yeah.
I wish I was richer than I am. That would be cool. If I had $1 million cash, just kind of throw at stuff, life would be cool. One day, let's get there. So yeah, that one I don't know. I'm just kind of reeling in that right now. Let's talk about Jamia because at least this is another one that pisses me off, but nevertheless, should have a much larger position than I do, but I don't because never mind. Don't need to get into it.
Yeah, don't double down on your pain.
And that one wasn't my fault, so it frustrates me less. It was basically what my broker was like with my retirement accounts was like, hey, just dude, like we don't have any coverage on it, but kind of gave me like I was like, just do it. It wasn't like, hey, let's discuss it. It was like, hey, just do it. Just do it. And he didn't. And so I was gonna put basically it's 20 grand cost me, but we're here. It's up. If you guys have been following this, it's green. We've talked about this one a lot. I just wanted to give you a little peek at this chart. It has hit
You're not sharing your screen.
Oh, sorry. I just wanted to highlight that it has, in fact, hit our expected target that we laid out for everyone, which was right here at $9. So that's 105.9% upside from our mention. Obviously, Shy was buying this even earlier around the threes, but we gave it to you on the stream at 430, 427. Hit our it's fun when you can give 105% target and it gets hit in like 2 weeks, 3 weeks, whatever it is. 1, 2, 3, 4, 5, 6, 7 weeks.
It's funny because I own more Jumia now than I do Celsius. That's just how it's just weird because I got into Celsius in the teens and now I've trimmed 50%. I was trading at $90 or $85. I have proof because I know a lot of gurus out there claim they sold their Celsius a week or two ago. I posted it online. Here's my proof. Anyway, that's a different story. If you go on the weekly, is this the weekly chart of Jumia or daily?
This is the weekly.
If you look at the volume shelf on the weekly, if you use this, it's once it clears.
I don't have that on mine. If you want to pop that on.
Yeah, let me share. Come on. All right. So let's get more specific. Look at this volume shelf right here. Let me get rid of some lines. All right. This volume shelf, once it clears here, do you guys see the blue skies ahead? It's disgusting. It like, I don't know when, but that's in a world like when I say like, oh, I think it can hit $20 really quickly. It's because once it clears like 860, which it did, if it holds there, it's going to fly. There's no volume shelf above it. It's going to squeeze up and it's going to hit this $29. Let's just round up to $30 on a gamma squeeze. And it's kind of justified a little on fundamentals because, again, when I was adding in the 2s and 3s, solvency risk was priced in at 90%. What does that mean? They gave it a 1 in 10 chance that it was actually going to survive. So a lot of people, fundamentals didn't matter for the name like Jumia because they just thought it was going to go bankrupt. Like no way they can be profitable. No way they can actually have the cash on hand to fund their business. They're going to dilute. And I won't be a dead horse, but I made the argument on why that's not the case. And that's why I was adding a ton in 2s and 3s. And now it hit $10 yesterday. But I think that it can squeeze to 20 to 30 because if a stock was priced 1 time sales, it being priced 5 times sales, that's a 5x right there. And that's why I'm saying Jumia can have like that fundamental validation of hitting $20 to $30 because it went from being priced as a bankrupt company to now a respectable e-commerce presence in a growing region. That's a 1x multiple to a 5x. And that's what $20 to $30 range would be. So I don't think it'll get there unless there's some kind of gamma squeeze until they have that 1 quarter of like they make the announcement of we're going to be free cash flow positive during this time. And there's no more solvency risk. There's 0. And we're going to be break even at a minimum for the rest of the time. I think that's like when it's going to hit that $20 to $30 range. So do you think we have some time? But there might be a gamma squeeze into like the 16 to 17 range. But I always get asked like, when can I add? So clearly I love this, like the best case scenario, if it ever hits this black line, which is the 200, the 40 SMA on the weekly chart, which is essentially the 200.
Excellent.
Right here, 430. Oh, I'd load the boat. If it broke $5, I'd double my position. I don't care if I got in.
I want to make a call out here, guys. So think about this. The guy's telling you, hey, this is a significant position in my portfolio. I would love it to drop 50% from where it is right now. That's the mindset you need to have day in, day out. But you can only have it, here's the caveat, if the conviction exists.
Yeah, if you know the company in and out, that knowing that if it goes down, it's a sale, not a spiral of fear and FUD. Yeah, that's why you got to do the research and follow the people that actually know what they're talking about. So like I'm providing you guys all the conviction. You don't have to do the research. Like I'm talking about it. I provide proof on it. Like, so yeah, Austin, that's a great point. I never thought about that. Like I mentioned when Snowflake was over 200, I kept saying, oh, I only have like an 8% position. Like I will love it if I can get lower than Warren Buffett's price, which was 120. Guess where we're at right now at Snowflake in the 120s. And guess what I did? I tripled it and I'm smiling. Like I'm happy. Like I'm down 6 or 7% of my position right now, but I'm smiling because I got to triple up my Snowflake position under what around what basis. Exactly. Like
it's just like class cost basis. Because
it's just like
you could say that big war is that defining character. He's the defining character. I mean, the guy, you can't argue.
So when do you want? So I know everyone's now believing the Jumia story. A lot of people laughed me off until it broke out after like $6. Now they want to participate. So when do you participate in a stock like this? When it's trading at $9, it's up 150% for the year in the first 6 months. And I'm saying like I could see it hitting 20 in less than a year. When can you get in? Do you get in today when it's down 10% from its highs? Sure. But I think I would start DCA a little under 7. So clearly you saw right here it was getting respected over here on this uptrend. Every time I dipped, it got bought up. So clearly that's getting respected. So I'd start, all right, if on a 3% position, I'd start a third of that, a 1% position at under $7. Next one, 21-day moving average. Where's that? 575. And then the next one, 200-day, is right here at, what is it, 430. So those are the prices. Let's just say 7, 575, and 430 is when I would add. And again, I don't think we'll ever get down here. I really don't. I think best case scenario, I don't know. I could see it consolidating right at the top over here. Or let's zoom out. I mean, yeah, I honestly see it consolidating around the $7 range, probably until the next earnings cycle. If like the market isn't raging, like small caps are not in favor. Look at IWM. Like IWM is ugly. And this isn't, I know we're diversing a bit, but like, this is why I hate investing in ETFs. Like, fine. Like you got a lot of people work full time. A lot of people don't have like maybe the experience or the enthusiasm or even like researching companies. So they can't pick 15 or 20 stocks that they want to invest in. So they go the ETF route. Fine. I respect that. it's a highly risky world when you have to like hand pick 15 names and you can underperform the market and you just missed out on like the market move. IWM, the way it's set up, isn't set up for success for long-term investors, because let's just say there's a super microcomputer, SMCI, perfect example, small cap 2 years ago, raged due to the data center explosion because were the picks and shovel play of the server space for data centers. So like they're clearly capitalizing on that big bump. And what happened to SMCI now that they had this massive move? They left the IWM. That's an example. Winners always leave the IWM because they get too big. And guess who stays in the IWM? Very young companies who rarely get to the mid cap, or the losers who just lag. So like, why invest in an ETF that has their winners leave their family and they don't really like let the winners keep riding the ETF and capitalize on that move? They just like
Holy
they leave.
shit.
Like,
I never thought about it like that.
yeah,
that is
like,
insane. It's insanity.
It's insane. That's what it is, though. At the end of the day, so that's why I'm like, I hate people who invest in IWM. It doesn't make sense. And also, if you like, a lot of people don't know, regional finance banks are a third of the IWM's components. So like,
that's terrifying.
KRE is a regional banking ETF. So like, that's dragging down the IWM. And you're seeing like, all right, well, actually, whoa, damn, I wish I saw this. I would have shorted, I would have bought puts. Like, oh man, so the 200-day moving average, you see this downtrend. I was like, oh god, this is right when it broke here. I would have bought puts in the $60 range, and I would have made bank at 36. Anyway, that's a different story. So now it recovered it bounced off here, it respected it. It sliced through here real quick. So like again, I could see.
Dude, we outlined this. We
did
sub
okay.
45. We already did it like a couple weeks ago. We were when it was still trading up. We talked about, hey, there's still more downside coming below 45. This is a steal to short to 30. We gave him that.
Oh, perfect.
That's
the case. I forgot, but that's the case. Like I might enter some puts next week.
I mean, look at that gap down. Go back to April. I mean, geez,
yeah,
madness.
And also, what's scary is look at this volume back-to-back weeks.
Yeah, it's just picking up pace.
It's like there's no respect for that 200-day,
and buyers are not going to congregate here until you see 37, and they're just going to protect. It's not even that's the difference too. I think to highlight is like they're not buying like this is it. This is the future. Let's hold long and strong. They're buying to protect their position while they wait for an out. I think that's an important thing to understand. Oh, he froze. VPN issues. Can you guys still hear me? Is he just frozen or are we both frozen? I can never tell. Come on, somebody give me some feedback here. Can you still hear me? Yes or no? Okay, cool. So then we just got to boot him for a minute while he reconvenes. So we were just chatting a little bit here on YouTube with my new friend Gurpreet here, who was talking about snow leaps, and now I am interested. Let's make this a little bigger. Sorry, I just wanted this up just to test something real quick. So using a simple fib retracement, right, off the highs post IPO to our low, which was about 110, we know that this is validated and that these price objectives are going to hold. So he's back. There you go.
My bad.
VPN issues, I figured. So we're going to map out real quick this snow because I think that this is worth discussing because I like this as a long-term options trade. And he's right. And if I'm going to start loading the boat, I'm going to be buying. So just to be very clear here, I will be loading this position here, anywhere in this green circle from 127 to 105. They're not cheap. So a spread will be necessary for a lot of people, depending on the account size. But I did want to highlight this because I think it is worth looking at, that we got a 116% move in 182 days. So it took half the year to move that far. And then this most recent move off 143, which is our first critical level we need to regain. And then as Shai mentioned, 164, we have highlighted 165 is pretty much our pivot point before we see upside. So we'd be buying the absolute bottom, low risk, because should we drop below 110, we exit the position, take a 20% loss. It is what it is, because the upside is easily 5-1. We're talking 100% upside minimum. So again, for every $1 we risk, we're going to make 5. I'll take that any day of the week. 1 to 3 is even quality. So to take a deeper look here, just to kind of price this out and give you guys some idea of like where we look to basically, like when we build these positions, how do we look at these? We're going to go to the options chain here, and we're going to pull up Snow Flizzy, trade individual options. And so we talked about on that chart that we had a 116% move over 182 days, again, post IPO, when it was holding above 184. We're trading below there, so we can't expect that move to hold up and be kind of our move that we hang this trade on, but we can take the moves that we saw off 145 and use those as it moved from 145 to 232. So that means that we need, at the very least, for that move, it was about 100 days. So we've talked about this at length, guys, that options function on a bell curve. Very important to understand that. I'm going to flip back to the chart to show you what I mean. Options function on a bell curve, right? So I need some space to do this, all right? So as we go up and then we go down, all right? Your time value is here. That's your x-axis. For those of you that remember this from, I think, elementary school or whatever. That's your y-axis, right? So this is time. This is price. Our goal is to take profit on this trade at one of these 3 points. We either want to hit it right before we peak, as we peak, or on the downslope when we realize that the trade is dying, right? So we want to just basically capture max profit while taking into account the risk. So the problem here is the closer you are to the strike price and farther you are from the expiration, the more this is worth. If you are not close to the strike price and you are very close to the expiration, this is what happens. This is the value of your contract, right? This bell curve right here. This is the price of the option that you're trading. It goes up, and then eventually, if you're not at the strike, it starts going down. Basically, the market is saying, hey, we're losing confidence by the minute that this options trade is going to hit the expected target, so we're decreasing its valuation, right? So as people become less confident, it becomes worth less money. So looking at this bell curve then, to flip back to the chart, okay, so, oops, oh, I didn't do that. So looking back at this chart, I just zoomed in this a lot, my bad. Looking back at this chart, we could see that we moved from 144 to, yeah, we're on the chart, cool. Moved from 144 up to about 230 over, what is that, 100 days. So going back to that example where you look at the bell curve, right? If we have 100 days of time before it makes that move, we don't want to set our expiration at that end of the 100 days because that's an estimate. We want to give ourselves at least double that so that by the time it hits 100 days right here, we are hopefully close to that strike price. So when we go back to the options chain, we are going to give ourselves roughly 200 days. We could go December 20, that works, end of year. And we were looking at like 230 being that strike. Now, we also don't have to go that far. This is mostly based on cost. If we think it's going to hit 230 in 200 days, let's be smart about this and let's capture that delta. Does anybody know how you maximize your return on options by leveraging the right delta? This is when you have out of the money, at the money, in the money. When you're in the money, that delta accelerates at an exponential pace, meaning little moves in the stock. Once you're in the money, that's for those of you that saw my 2,400% return on those NVIDIA calls that were at $250 strike. Even though we were close to the expiration, they just kept going up because they're already in the money. There's maximum confidence. So with this trade, we want to be smart, and I say we shoot for 200. Open interest isn't great. Implied volatility is in the acceptable range. I always shoot for below 50%. Best case scenario, below 40%. But we'll take it. We don't have a ton of volume or open interest, so be mindful. That's a huge spread. So do not get beat by the spread. Delta hasn't accelerated yet. There's upside. Gamma, there's upside. Theta, obviously minimal. The rest you don't really need to worry about. but we want to see this implied volatility go up and we want to see the delta go up. Then no matter what, we're making more money. So I'm liking this $200 call. I mean, Shai, what are your thoughts on this? I mean, we're basically, here's our calculated bet. We are betting that Snowflake bottoms here and hits $200 a share, which is right about here. We're betting that Snowflake will hit. So what's the expiration on those? It's December
20th. Yeah.
Yeah.
So I do love that expiration date for December 20th because it is the cheapest. September, October, November are really expensive due to election and also weak seasonality. January is some reason really expensive right now on the option chain. I don't know what that indicates. Maybe the first 100 days of a president, who knows? But December is dirt cheap, that you'll get the most kind of juice to be squeezed on that IV and delta that Os is talking about.
Yep. And I think that that's our trade for those of you that were interested in capitalizing long term here. And to put it simply, what we could expect on this trade is I would shoot my targets for like $7 a contract, 100% upside. I think we'll get far more than that if we escalate more quickly. So just to be very clear, and I will be updating this position as I add to it, as I sell it, as I have thoughts on it in the Discord. The link's at the bottom, so make sure you get in there so you can get the updates. I do have one request I'm going to honor right now. I don't even know anything about this Autodesk. Have you ever heard of this shit? ADSK. A chart.
Yeah, it's a great company. It's a storage company. Essentially, all the memory needs to be stored into like.
Ooh,
Colab. Oh, wait, no. I'm talking about Pure Storage. Sorry, Autodesk. Yeah.
I mean, look, this is a hell of a story here. If you look at this chart, it's just like infinite growth. I mean, if you look, Jesus, I mean, this has been a long time. What is this company? 1986. Can you imagine? You're in this
forever
at pennies. Like you have. Well, I'm trying to even conceptualize what you would have in your account if you had $1,000 in this at 20 cents. I don't even know what percentage that's. I got to calculate this, dude. And this is why time in the market is essential, you guys. Essential. And this at some point was a small cap growth name. That's my point of what we're trying to get across here, you guys. This at some point was a small cap growth name. Is that registering? We're talking to you about small cap growth names, mid cap growth names, even large cap growth names that aren't getting the love they deserve because we're betting 10 years, 15, 20 years out. So to look at a company like this, like, my God, in the 80s, if someone had the wherewithal to buy this at, say, I don't know, the 40 cents it was at, let's take a look at what percentage increase that is. So 0.4 to 220, 54,000%.
Wild. Absolutely.
So
wild.
what would that be worth? Be $1,000 in it at a 54,000%.
It's 54 mil.
Oh my God.
No, it's stupid. No, it's wild. But to go off more, I've got to add some more color on that Snowflake trade you just called out. Another reason why I love December is because this most recent earnings cycle, almost all the software names who were reporting their earnings and also management, when they talked on the calls, they said they had weak Q2 guides, which is why a lot of the names have faded hard, but they had a big bump up on the full year guide. What does that tell you? So I've been being a dead horse to this, but I'll say it again because I'm sure we have new listeners. But any kind of initial wave of any revolutionary technology, the first thing to do is the essential infrastructure of that related technology. So for AI specifically, what is that? That's the chips, the semiconductors, the NVIDIAs. That's the servers, the super microcomputers, and that's the Dells, and the computing power, which is the infrastructure players like the Google Azure, Microsoft Azure, Google Cloud, AWS. Those are they're gonna be the first ones to feel the immediate bump up from this AI revolution. So historically, once this phase happens, there is a lag between infrastructure investment, which is what I just called out those names, and the broad adoption of that resulting technology, which is the application layer of the digital economy, which is the software names. Nobody knows the duration of that gap or that lag. That's always been a mystery. That's why I love front running it, because I was like, I'm not good at timing it. I just know it's inevitable, and I'm going to pick the best names, get ahead of it. I'd rather be first than last. If you're going to hear what all the management said in the software earnings, that week Q2, so nothing's going to change in the next 3 months, but they expect a bit bump on the full year. That tells you, if you read between the lines, the second half of this year, Q3, Q4, that duration of that gap is going to close, and they're going to see that immediate impact from this AI investments and this boom. So if that's the case, Snowflake December 20 calls, they're going to start seeing that bump in the Q3 earnings, and there's going to be a ton of new investors coming in. Like everyone who's investing in the infrastructure space of this AI race, like the semiconductors, the big tech, like they're going to probably transfer that dollars towards the application component, which is the software names, like the Snowflake, the MongoDBs, the Cloudflares, the Atlassians, like Confluence, like all those names. If once they see the immediate impact of this AI boost, it's going to last a lot longer than the hardware and the infrastructure names, because the way data works, the business model is consumption. It doesn't go away. It's not like, oh, I'm going to get a ton right now and then see how it goes and then add more down the line. No, the way these data works is it constantly gets added. You're going to need more and more and more. There's no up, down, like in hardware. It's legit just an S curve. So that's why I love the adoption component of it. And once you get that first earnings cycle that, wow, software is getting that big impact, or specific software names are seeing that AI boost, there's going to be a massive move. And that's where the December 20th call, if what management is saying from all these software names are true, we could see that December call just being like going through the roof on open interest, on volume, and that alone will cause about IV of those options to spike, and it's going to cause those options contracts to be even more expensive.
And you heard it here first. Look at that. That's the best part. You heard it here first. So basically, let's really quick, because we're pushing up against the time here. Let's talk something that is not had the best day. I'm on the wrong one. DigitalOcean. So there's their earnings. I was just checking on that. Hey, there's their earnings. Phenomenal. This is what we're betting on in our long. We also have a long-term options trade open on this one. Get in the Discord if you want that. I posted it in there. To flip to the chart right here, you can see that we've got 35.03, a little bit of downside after some strong buying last month. Excuse me.
Did you notice anything on the downside? Low volume.
I know, but that's what I was asking. If there's any news or anything that was the reason for this nonsense.
I read a channel check. Azure, which is Microsoft, might be starting to pivot towards SMBs in the cloud computing space. I think Morgan Stanley had that. It was their research paper. I read that this morning.
That's annoying.
I'm not worried about it. It's like, again, I think there's some fear, but it's been a big mover right now. Like, let me pull up my model for it. Like, I already, fine, I'll say it. I have a $75 price target on DigitalOcean by 2026. So
Agreed.
I have a massive move. That's a ballsy prediction for me right now on a company that's less than $5 billion valuation. Yeah. But like, I think it's gonna be a massive winner. Right now, they're being priced at, I'm putting my model, they're trading at 16 times EBITDA of this year.
Which is
so
crazy.
What is that? It's dirt cheap. And this is a company who's growing the low teens with 20% free cash flow margin. So like, I'm underwriting a big pickup on the revenue on Q4 of this year. And I'm thinking that's going to flow through next year. And those low teen growth, I think we're going to be pushing close to 20% growth in 2025 and 2026. If that's the case, this company will get re-rated, and that EBITDA multiple of 17, that's probably going to go closer to, like, let's see, what's Datadog is 60 times EBITDA multiple. So that just shows, like, and it's a different company, it's different business model. Fine, I'll use Atlassian. It's 40 times EBITDA. So essentially, it's going to triple their EBITDA multiple if I'm right on the underwriting of the 20% growth. If that's the case, that $35 target, and I'm saying 75, that's actually kind of conservative. So I think this is going to be a big winner. I'm taking it quarter after quarter, but It had a big move past month, and it had a pretty big fade this week, but it was on low volume. There was no follow through. End of the day, it is. Let me look at the charts. It held up.
It needs to hold. I just really want to see it hold 35.
I was going to say there's a massive volume shelf at 35. So like I really hope it holds 35. Worst case scenario, maybe it hits $33.
Yeah,
maybe
33 to 31. I'd take 31 and I'd be just fine.
I'd be fine. But again, like by that time that happens, they're gonna have their earnings report. And what have we seen the past 2 earnings cycles? Infrastructure and AI is
down, dude. They crushed.
They crush, and it's you'll get a precursor with AWS, Azure, and Google's earnings report before we see DigitalOcean, so we can see how is infrastructure spend happening in the AI space for the big names. Is the party continuing? If it still does, like I said, there's a lag between enterprise players at that scale and SMBs.
Yeah. We'll get a front run is what'll happen.
Exactly.
Which is cool. I'll take it. I like it. Beautiful. So final thoughts, man. What are you thinking? I mean, final thoughts. If we so where do you think we're gonna end up?
All right. So I think we're about to enter July very quickly. July is the month where all the big dogs go hang out at their beach house, take the month off, vacation. So there's gonna be I'm most likely there's gonna be no trend breaking in the market. And why do I believe that? It's because for a trend to break, there has to be some kind of volume to like have some follow through. And I think with all the big dogs gone, that won't be the case. I see the indices, the SPY, QQQ consolidating, but I see the real alpha being played on these lagging high quality growth names. Today, what names showed a ton of relative strength? The lagging high quality names, the Snowflakes, the MongoDBs, Atlassian, Cloudflare, they're all up 3% today. When SPY was red, RK was down 1.5%. I think that this might be the beginning of like not a rotation, but I think the alpha will be made in those lagging high quality names where they might catch a bid, might recover because a lot of them are way oversold on the daily charts.
Yep.
And while the indices consolidate on the top, I think under the hood, those kind of names are going to catch a bid. And I also think small caps might be struggling. I wouldn't put my chips in small cap because after the Fed meetings this week, the dot plot, it showed like, like maybe like I thought maybe there'd be 2 rate cuts this year, maybe 3. That dot plot was hawkish. Like they don't expect much moves this year. It's really gonna be 2025. And because of that, I think the narrative of maybe a cut in July and a cut in September and possibly in December is out the door. I think July and September maybe, but it sounds like it's gonna be September alone, and that's it. If that's the case, I think all the interest rate trade is out the door for small caps, and they're going to struggle. But caveats, July is a month for retailers because, like I said, the big dog players are gone. So the retail volume is usually really high on like those gamma squeeze names, the GameStops, the small cap names who are interest rate sensitive. Like I could see those names maybe potentially catching a bid, but also immediately fading quickly. So that's what I'm like monitoring. I also do think some election noise is going to start coming into the market, and that's going to be a big headwind. Nobody knows who's going to be a president. Nobody knows who's going to actually run, which is wild to say because it's less than 6 months away. There could be a case where Trump and Biden don't even run. Either way, I do think today's tell of the VIX like being up 8%, there could be some positioning happening for the election. And if that's the case, I think there might be some like profit taking happening because the QQQ and SPY, they're up 12% in the first 6 months. They can just take that profit and put that money into some treasury and make 5% to ride out the noise until election. That's what I can see. I know, Oscar, you're trying to share your screen.
No, I was going to wrap it up here.
So that's what I see. I think if we see any kind of red in the market, again, I've been very open, like 21-day EMA, watch out for that for the SPY. If that breaks, check the 50-day. If the 50 breaks, I get defensive. I will get defensive in my position in the market. And
long-term VIX is still pretty fucking tame, dude, on the monthly.
Dude, it's going to hit 20 before the election. Again, I've been very open. Like it's going to hit 20 multiple times. We already got it in April. We're going to get it again. I think it's going to be end of August, September. We're going to hit 20 again. So maybe there's a trade we can do on VIX, but we're too far ahead in that where
yeah.
like you don't want to do 3 months away. It's a very short-term trade, but
That's a cyclical and historical trade. October is actually always up.
Yeah, September is a really bad month in market. There's a ton of seasonality weakness.
Yeah,
in
it's
September.
usually just an atrocious
Bloody.
adventure through red abysmal stuff. But there you have it, you guys. So look, Monday, 5 p.m. Eastern, do not miss it. We're going to be back and going through this, and hopefully we'll be able to sift through some of this noise and give you a better outlook on what's going to happen over the next month. And again, we have some big announcements coming between Shy and myself, and some things we're going to be doing for you guys. And you guys are going to love it, and I don't want you to miss it because it's going to make you a lot of money. So if you hate money, don't show up. If you love money, then we'll see you there. So love y'all. Stay blessed now.
See ya.